This conference will now be recorded.
Okay, so we now begin to go through the balance sheet and look at selected items. We've gone through the accounting cycle, including adjusted interest. We know how to prepare the first three financial statements. So over this week through next week, we'll be looking at the cash account, getting some more detail on that, accounts receivable, plant and equipment in terms of how to calculate depreciation. So with the cash cycle, we start off with cash in the bank. We purchase items, set up an account payable. Then we sell items, sometime for cash, sometime on account. Then we collect it. We pay off our expenses, and then we get into, okay, what's remaining, the remaining cash in the bank. So we have a cash cycle, and we have to study this cycle. A business does, just like you personally. If you own a car and if you pay rent and utilities, at the beginning of the month, you got to have enough cash to do that. So when we're running a business, we have to make sure that we can't just take it for granted. We got to make sure that the cash is there. And of course, cash is something that we have to be very careful and protect. I met with a vice president of a bank several years ago, and he says that they fire a teller once a month. So in the Houston area, this bank was firing a teller once a month. So why do you think that was happening?
They messed up on their money or the numbers not right?
Yeah, that's part of it. But they help the numbers not to be right. Typically by pocketing the money. Yeah.
Stealing?
Yep. So when you got you think all these businesses out there now that you deal with, and most things are non-cash transaction now, so you have other issues. But if the business has cash, well, you really have to have some controls in place when cash is being collected. And just in general in dealing with cash. And so what we do is we typically have a sales and cash receipts journal. So we just put all the sales and cash receipt transaction in one journal, and we post that. And then we do a daily cash sheet where we lay out the cash that's supposed to be there. So based on the cash registers, assuming there's a cash register, the tape lays out what's supposed to be there, and then we got to count it to see if it's there. With the bank tellers, they're taking in cash, giving out cash. They got a daily cash sheet that they have to show, which shows the cash that came in, the cash that went out, and the balance. And they have to have in their cash drawer that balance, or if you're a cashier, you have to have that balance in your cash register. And so that's why cash registers are locked, and because the person operating that register is responsible for it. Then we have a cash disbursement journal. We do all the payments out of that journal. So those things are helpful. So rather than one journal with all the transactions in it, we typically are going to have a number of journals. Sales and cash receipts, all sales and cash receipts in that journal. Cash disbursement, all payments. And then a general journal that records all the non-cash transactions that are not in the sales of the cash receipts. Sometimes we'll have a purchasing journal to do all the purchasing. One of our focuses is going to be on the bank reconciliation. So one of the ways you control cash is doing bank reconciliations. Companies also have petty cash funds and, to pay small items. Most times they use a debit card now, but once there will be a box with money in it and somebody responsible for that box of you paying for postage or small items that are coming in. Girl Scout cookies, you needed cash to do that. So you wouldn't write a check for everything. So you had a petty cash fund to handle small transactions. So we get into internal controls over cash and everything. It's received. When it's received, it's got to be counted. You see two people here counting too. Then it's got to be deposited. Then it's got to be recorded. So what you're seeing here is once cash comes in, two people count it. A black suit, purple dress. Then a gray person takes it to the bank, a gray suit, then a blue suit records it. So that's the separation of duties that you got to have when you're going to control the cash. So the first two people count it, then they give it to the person in gray to deposit it. And then they say what the deposit should be, and that goes to the person in blue who makes the report, who records the deposit in our accounting records, and it all needs to agree what's counted, what's deposited, and what's put in the journal entry debit in cash. They all need to be the same thing. And you got to watch cash because people will take cash. So we have internal controls, all the procedures we're going to put in place to prevent employees stealing cash and other assets. So if you got an inventory, and there's certain types of inventory, that inventory has to be protected on the lock and key. You got telephones, etc., computers. Controls have to be in place. So we have the internal control process. We need a control environment. We need control activities, checking keys. We need information communication. We need monitoring. So you see a lot of the cameras now. And we need a risk assessment in terms of what's the risk involved with this particular area. So that's the internal control process. Then we have the Sarbanes-Oxley Act. People begin to act crazy, especially in Houston, creating scandals about their financial statements. Enron in the early 2000s, Stanford Financial Group afterwards. And so they passed the law that makes the president and chief financial officer certify that the statements are correct, and then they can more easily put them in jail if there's a problem. Presidents were saying, well, we didn't know what was going on. Well, if you're president, you're supposed to know. And so Sarbanes-Oxley comes in. If you got a large company, it puts out some financial statements, then these people certify that they're correct. And COSO really relates to this. They've got some things that they look at in terms of the environment. So they say for an environment, what's the tone of the organization? In terms of awareness. So do people feel that we're supposed to be following appropriate procedures and protecting company assets? Risk assessment. There's a need in general, if a company has goals and objectives, to look at what are the risks, what could happen that would keep them from accomplishing those goals. So that risk assessment is very important. Because if there's a risk to you getting what you're supposed to have, then that's a problem. Information communication. So there should be information that flows, that tells people what they're supposed to be doing, how to do it, and when they're supposed to do it. And then we have control activities, surprise audits, labeling things, then the monitoring process. These are your cameras. So in summary, internal controls are the procedures utilized by companies to safeguard its assets, process information accurately, ensure compliance with laws. So if there are state or federal laws, that's part of control. The elements of internal control: control environment, risk assessment, control procedures, monitoring, information communication. The control environment consists of, we talked about this, the management philosophy and operating style. Does the company believe or have a philosophy of doing things in an ethical way? Or are they going to, whenever there's a problem, there's a weather problem, then they're going to gouge people, increase prices for no reason? So there is that control environment is very important. Structure your personnel policies. Then the procedures. You should rotate people and have mandatory vacations. You got to separate responsibilities. You saw that with the cash. You separate operations and custody of assets. That is, the person making the journal entries should not have custody of the assets. And you need proofs and security measures. What are some warning signs? If you're running a company, abrupt changes in lifestyle, close relationship with suppliers, person getting friendly with the suppliers, then you might be getting kickbacks, people refusing to take vacations, frequent borrowings, excessive use of alcohol and drugs, missing documents or gaps in transactions, customer refunds. A lot of times in the sales, in the retail business, people are paid based on commissions. And so, and I had a student tell me about this, she got caught up in this. She'd have her friends come in and buy something, then she'd get a 20% commission. Then the friends would come in and return it later, okay, and get the money back. But she's got a commission. Eventually you get caught on things like this, because it bills and it's checked on. So she lost the job and had to pay back all the money. So no job, pay us back. If there are differences between the daily cash that comes in and what's deposited in the bank, that's a problem. Slow payments, backlog and recording transactions. So these are 10 things that when you are managing a company that you look at on your employees, because you got to protect the cash and all assets. If you don't, they will disappear. Any questions on this part, dealing with internal control and the need for internal control? Should not be a problem with understanding this. Let's move on to bank reconciliations. Sometimes if you're running a company, and even personally, your cash account may show one balance and the bank statement shows something else. And so each month, a company is going to reconcile its bank statement. That's a key control process for the cash. to see why a difference exists. So there's the two things. There's a bank statement and there's the company's accounting records. So we'll do a bank analysis, then we'll do a company analysis. So there are two bank records that are prepared, and they got the balance, the bank analysis, and then the company analysis. When we do the company part, we enter the cash balance from the bank, excuse me, this is the bank part. We enter the bank balance from the bank statement. We add deposits in transit that the bank don't have. So we're going to add deposits in transit that the bank doesn't have. We're going to deduct checks that the bank hasn't paid. Then we're going to determine our correct balance. For the company, we're going to enter the cash book in the ledger. We're going to add credit memos that have not been recorded by us. So interest income, notes collected by the bank. We're going to deduct debit memos such as service fees, customer checks not paid. So we got two reconciliations, the bank reconciliation and the company reconciliation, and they got to be the same thing. So let's look at this problem written by a former student. And he had a successful business, and he said in his problem, on April 30th at 12 p.m., his bank balances were as follows. So at noon, the balance per Chase was $20,000. The balance per Sebastian was $20,000. That was at noon. At 1 p.m., Chase posted the following. It had $500 for interest. He got a lot of money, made interest. It deducted $100 for service charges. So it said his balance was $20,400. It added $500 for the interest it gave him, deducted $100 for service charges. The bank showed a balance of $20,400. Sebastian made a deposit at 6 p.m. of $3,000. So that was his last deposit for the day. He made a cash withdrawal of $500 for weekend expenses, and he wrote a check for $1,500 to pay his rent and gave that to the landlord. So when he looked at his checkbook, which would be what would be in the accounting records, he showed $21,000. So the question is, what is the correct bank balance that Sebastian has at the end of the day? On April 30th at 12, they're both at $20,000. What is Sebastian's correct balance at 12 midnight? How much money should Sebastian have? Okay,
21,400.
21,400. So how we get 21,400 as his correct balance? Let's do a company analysis first. So his checkbook says he has $21,000.
Wouldn't he have 15,000?
Gracious, Chelsea, you say he have 15,000? You might have a little bit more.
I got 21.4.
21.4. Well, let's look at it and see. So what we're going to do in our company now, we're going to go up here to this bank statement and look at items we don't have. The bank gave us $500 for interest. So we're going to get the interest income. And so we would subtract that, we would add that. And so after we put the entry down, we had 21,500. Then the bank had a service charge of 100. So we're going to put the service charge in here for a 100. So the total unrecorded charges are 100.
So are
So
we adding that 500 or subtracting that 500 for the interest income?
if this was your bank account, what would you do if the bank gave you 500 interest?
I'll keep it.
So would you add it or subtract it?
Add it.
Okay. So the service charge we subtract, and so someone said the correct balance is 21,400. Okay. So when we do this company analysis, we look at things the bank had that we didn't have. Now we got to do the bank analysis. So we're going to start off with the bank. The bank says the balance is 20,400. Okay. So we're going to add this deposit in transit. The bank don't know anything about this, so we add that. So 3,000. And so, well, let me just put 23,400 based on this 23,400. So our subtotal at this point is 23,400. That is, the bank gave us 3,000. So I mean, we gave the bank 3,000. They didn't have it, so we putting that deposit down. Then we're gonna put down other items. The bank doesn't have the 1,500, and they don't have the $500 debit card withdrawal. So the check for 1,500, we put that here. $500 here. So there's a subtotal of $2,000 of items that are going to clear the bank eventually, but they're not there yet. We subtract these items, and so we have 21,400. So if you're running a company and you got lots of cash transactions, you got to, each month you're going to do a company analysis, you're going to do a bank analysis, and they have to be equal. Any questions?
So far, so good.
Okay. All right, so take a screenshot of this. This is your bank, this is your practice problem.
So you said the company analysis and the bank analysis got to be equal?
They got to be equal. Shouldn't they be equal?
Yeah.
All right, so here you go. Situations A, B, and C. So you all have this down? Got a screenshot of it?
Yeah, I got a screenshot of it.
All right, so with your screenshot, now come in here and do your bank reconciliation. So do 3 bank reconciliations based on those 3 scenarios.
I didn't take a screenshot fast enough. Can you show the problems again?
There they are.
And is this in Blackboard?
Say that again.
Is the sheet on Blackboard?
No, it's in the primer, but it's not on Blackboard. Yet I might put it in there.
Okay.
So can you do a simple bank reconciliation? with these correct balances being the same.
Professor Boyd, so are we taking from the bank reconciliation practice problems, or are we just taking those numbers and jotting them down here?
Yep.
Okay.
So you got to put them in the right place.
Okay, got you.
You got a balance per books and a balance per bank. You got outstanding checks, deposit and transits, interest income, service charge. So you got to put those in the right place so that the balances are the same.
Can you scroll back down, please?
Here, let's see if we can do the A1. Okay, so the balance per books is 19,500. So we're going to put a 19,500 here. How much interest income did we earn?
20,000.
Not 20, but
Oh, the interest earned? Oh, it's 2,000.
what was our service charge?
500.
500.
100. So what's our correct balance?
20,000, 22,000.
Say 22,000.
Yes.
Okay, so let's go to the bank analysis and the balance. Okay, we've done the book analysis. Now we need to do the balance. The bank said it was what?
I got 21,000. How'd you get 22? Yeah.
Same as me. I got 21,000 as well.
Everybody's saying 21,000.
Oh, no, they're right. They're right.
You got
I added the service charges.
okay. You got to subtract them.
Okay.
So what's the balance per the bank?
20,000.
20,000. How much are the deposits in transit that they don't have?
Thousand.
5,000.
Oh my gosh.
Were there outstanding checks?
4,000.
And so once again, we get 21,000. Any questions?
Nope.
Okay, so you all can work on B and C at your leisure, but you should be able to do that. Now, when we do the company analysis, we have journal entries we got to make. We've earned interest income of $2,000. So we have to make this journal entry debit in cash, 2,000. Interest income, 2,000, because we don't have that recorded. And then for the service charge, we debit miscellaneous expense, 500. Credit cash, 500. So when the bank has items that we don't have, we make a journal entry. So our journal entries, items that the bank have is off this company analysis. It's items the bank have that we don't know about. And so we have not recorded the journal entry. Okay. And that will be the same. So I'll let you all work on that. Okay. We'll get into the complicated one, the complex one, and we don't want our A students to get bored. So here's some homework in here. So you might go through those. And here's your comprehensive problem. All right, so we'll get back to that next time. Okay, we ready for our final financial statement. We've learned how to prepare a balance sheet. We've learned how to prepare a statement of retained earnings. We learned how to prepare an income statement. We now have to do the cash flow statement. And there are three areas in the cash flow statement: operating activities, investing activities, and financing activities. Operating activities are like your salary. That's where your money needs to come from. Investing activities, you typically want to be investing more money in the business. But if you got cash from investing opportunities, that's just like you went on a vacation to Vegas and you sold your car. Not going to be a good situation when you get back, right? Especially if you lose in Vegas. And so positive money from investing is not what we want. Then financing activity, that's borrowing. Okay. Like your student loans, you know, what do you know about student loans? They generate cash, so they got to be paid back. So when we do a cash flow statement, we're interested in the cash from operating activity. That's where the cash is supposed to come from. Investing should be negative and financing should be negative. Such as with you personally, when you graduate, you want enough cash, salary, which is operating, to buy some more assets, not sell assets, get a new car. And then you want to pay off your student loan. So you want enough income to buy some new assets and pay off your student loan. So with a company, a good company has enough cash from operations, to invest in additional items. That is, to expand, it's got to invest. And then it has enough cash to pay its bills. Now, you will remember we said the purpose of business is to start with some cash and put it in common stock. We want the cash to go up through earnings. We don't want the cash going up because you borrowed money. That's just like you personally. You go borrow $10,000 on a student loan. That's fine, but eventually you got to pay it back. And so there are four components of a cash flow statement: operations. That's where cash should be coming from operating the company. And you see here $1 million. We'd love to have $1 million here. Part two, we expand it. A company is doing better when it's expanding rather than contracting. So the $1 million here, we're talking about Macy's, these are the clothes that we sell. The 400,000, 400 million is money that we're putting in new stores. Then we're paying off our indebtedness, so that's a minus 200, and we still have cash left over. So we had $1 million, we paid out 600, we still got 400,000 in cash left over for this year. So that's the type of analysis you're trying to make, and this is what you want to see happen. So you want to see cash remaining, but the cash needs to come from operations. Just like for you personally, it's best if your cash comes from salaries rather than the fact that you sold some of your assets, your jewelry, your auto, and you should be paying off student loans rather than getting more student loans. So this is what this analysis does. So we have the statement of cash flow. And with the statement of cash flow, we analyze where the cash is. And if you don't have any cash in operations, there's something wrong. Just like you personally. If you're running around and you have no salary, then you aren't going to go but so long. Any questions? Let's see if we can work a statement of cash flow. And we work it simply by reviewing all the journal entries in the time frame. Then we're going to delete journal entries that do not involve cash. Then we're going to complete a direct cash flow template. And what this template does is it shows you where journal entries go. From operations, it's telling you, first of all, journal entries 1 through 6 are sources of cash. 7 through 11 are uses of cash. So what are your sources? What are your uses? And the journal entries that are operating items are 2 through 5, short-term liability. Operating items on the expenditure side are 7 through 11. So 7 and 8 need to be current items. Then in part 2, we have cash from long-term assets, our sale of long-term assets, and the purchase of long-term assets. So those don't affect our operations. It's just like for you personally. You can be buying assets and doing this, but you got to pay your rent and utilities that's $1 a month. That's a whole separate thing. And so when you're running a business, you want to make sure they can pay their liabilities. Then you look at what are they doing in terms of investing. And finally, from cash flow from financing, is the company getting this cash because it's borrowing money, or is it paying off its indebtedness? And so as we do this statement, what we're going to find is that the sources in 1, 2, and 3 are going to equal the change in cash flow. That is cash flow change. How much of it came from part 1, where it's supposed to come from, how much from part 2, and how much from part 3. So let's see if we can look at an example. JSJ bookstore first year transaction are as follows. So the first thing I want you to do is scratch out transactions that did not involve cash. So that's our first step. Once we find out the cash transactions, then we put them in the appropriate place on here. So look at these transactions. So take about 5 minutes and look at them. Then we want to strike through those that are not cash transactions. We want to strike through transactions that are not 1 through 6 or 7 through 11. Okay, can we do that? Okay, so take about 5 or 7 minutes.
Professor Boyd, you want us to do the ones that are only incoming cash or outgoing too?
Yeah, outgoing also. So the first one, we know they contributed cash. So that's probably what type?
1.
1. So we'll leave it. First inventory on account. What type is that?
12.
What?
12.
Okay, so that's 12. So since that's not 1 through 11, we're going to strike it. Cash sales were 1,200 with cost of sales 600. Got to pick up the cash. We'll strike this so we don't have to worry about that. So cash sales is a type what? As we review.
Isn't that like collecting? So wouldn't that be like a type 3? All right.
Now it says cash sales. It didn't say you collected anything. So this is a 2. This
Yeah, it's
was
a 2.
okay. Sales on account were 1,400 with cost of sales 400. What we're gonna do here?
Scratch cost of sales.
What?
Shouldn't we scratch cost of sales?
Let's go back up here again. We striking anything that's not 1 through 6 or 7 through 11.
Oh, okay.
So let's type what, 15?
Yes.
So we're gonna strike it. Purchase of supplies, plain cash. What type is that?
A 7.
That's a 7. Paid salaries of $200.
That's a type 9.
It's a 9. Purchase equipment costing $600, paying cash of $200, signing a long-term note for the balance. What types are those?
Type 8.
Type 8. I thought we said this is an 8, 12 a while back. Didn't we used to say that? Oh, okay. Paid on accounts payable.
That's an 8.
8, so we leave it. Collection of account receivable.
That's a 3.
3, so we keep it. Paid on long-term note. I hadn't paid on long-term notes before. That's real.
No.
Y'all ain't paid on a note before?
No, sir.
Oh, Kelly.
I don't do notes. I do everything
What's
cash right then.
the last journal entry we typically have? Paid what? On your exam. Well, you typically pay, what's the last journal entry that y'all finally kind of knew how to do, what y'all have already?
Type
Oh, the one.
14.
Yeah.
What type is it?
14.
Got the word paid.
Oh. 15.
Oh, paid on long-term note. When you pay something, you got to be 7 through 11. Oh, that's
So
good.
is there 11?
It's a type 8.
Thank you, finally. Thank you.
Man, I
Paid,
was thinking of that too. I was thinking of 8.
That was literally my first thought.
It's
That
no
was
payable in cash.
paid dividends. What type is that?
10.
10.
Chelsea got no cheat sheet now. Supplies on hand at the end of the year. What we're gonna do there? Somebody who's that talking about adjusting interest? Well, we know adjusting interest don't involve cash, so we're gonna strike that. Depreciation expense does not involve cash, so we'll strike that. Then we sold equipment costing $250 for $100. So we don't worry about the $250. What type is this? What type of transaction is this?
2.
No, that's it. You're in the business of selling cars, remember? But you are close in the ballpark. So which one is this, Chelsea?
I'm looking at the chart of accounts, and don't remember which one it was.
Y'all get y'all transaction types. Suggest y'all get transaction types as we go through this. So sold equipment on account is, what does 6 say? What does type 6 say?
The type 6, it says sales of non-current asset.
Like equipment. That's a 6. We'll
Oh,
keep,
I overlooked that. My bad.
okay.
What was the
So
type number 13 again? You didn't put it there.
well, it's
I was just saying you didn't put it, but you don't have to.
but it's 12 and 13. Good thing you brought that up. What types of those?
13 is number 14, right?
Yeah, what does 14 say?
Recording of depreciation.
So this is 14. Yeah, okay. But that's not in that first grouping. and supplies on hand at the end of the year. We have something that says utilization of an asset in that same area. 13, what does 13 say? Well, we'll get back to that, but it's something like that. But the bottom line is that when we get ready to prepare the cash flow statement, we only want cash transaction. We only want transaction types 1 through 6, 7 through 11. If it's a 2, 3, 4, or 5 short term, it's in operations. If it's a 7, purchase of a current asset, 8, current liability, journal entry 9, journal entry 11, they're going to be in operations. Cash and sale of a long-term asset, that's going to be 6. That's going to be in part 2. Purchase of a long-term asset is going to be in 7. It's going to be a type 7, but it's going to be in part 2 also. So this template is showing you where each type of cash transaction goes. So journal entry 1, notice that that's cash flows from financing. You put money in. Then borrowing long term, then when you pay off long term, it goes here. And you pay dividends, that's here too. So what we're trying to do is to look at the cash transactions and what happened to cash from operations. The main thing you're supposed to be about. And what I can tell you this is that if you don't have cash from operations, there's something wrong with the business. If this number is not positive, that would mean Best Buy didn't make any money selling TVs or computers. That's what that would mean if this number was negative. You know, that's going to be a bad situation. If they made their money by closing stores rather than expanding, that's not good. If they made money, got more cash because they borrowed as opposed to paying off. So trying to get you to get a situation of, got a cash account. How much cash is in part 1 from operations? That's a good thing. How much from investments? Well, that's not going to be repeating. Operations should repeat year after year. Then cash flow from financing, where we borrowing money as opposed to paying off money. So did your cash account go up this year because you borrowed on a student loan? Might have gone up. That's going to be an issue down the road. Okay, so let's see if we can do a statement of cash flow with this example. And for your convenience, so y'all won't have to work too hard, I got the statement of cash flow answer template. Notice what I got across the top, the journal entry number that we're dealing with, the type, source amount, the use amount, then the net change in part 1, then the net change in part 2, then the net change in part 3. So let's see if we can work the problem out. How you all Excel skills these days?
Better than my word.
Oh, okay, well, good. Since it's good, I'll let you put this worksheet in Excel for me. So in the first transaction, so we only deal with transactions we did scratch out. So contributed cash, where's that going to go?
In the 1 through 6.
It's 1 through 6, but what is it going to be? Operations, investments, or financing?
It's gonna be investments.
No, That's your company that's your money you putting in the company. So for number one, that's going to be cash flow from financing. And that was how much? $200. 200, and we said that was a type what? 1. Now let's go to the next journal entry that we have, and we would go to 3. Cash sales were 1,200. So we know that's going to be what, in operations, because that's a 2 through whatever. So in terms of 1 through 6, we know they go here, but you look at this sheet to see whether they're in operation. So 1 through 6 is going to be a source. 7 through 11 is a use. But this table tells you whether it's in operations, whether it's investments, whether it's financing. So cash sales, so we have the number 3. That's going to go here. That's a type 2. And what was the amount? $1,200. Okay, just moving right along. Purchase of supplies paying cash of 100. So that's going to be a use. Purchase of supplies paying cash of 100. So that's transaction 5. But it's a use. So it's going to be purchase of an asset 7. And our amount will flip 100. So we're just going journal entry by journal entry that we did not strike out. Paid salaries of 200.
If it's striked out, what does that mean again?
Say that again.
If it's striked out, what does that mean again?
It does not go on the cash flow statement because it's not a cash transaction. That's a good question. Pay salaries of 200. So we're down to transaction 6. And we paid cash of 200. And we said that that's a type 9, payment of an expense. Hopefully we said that. Then let's look at this purchases of equipment. So we want to show $600. The net cash is 200. But we know we bought $600 worth of equipment. So when we do 7, 600, 200, we do 7, we purchase an asset. So it's a use, so it's going to come over here. And the asset costs $600. Okay, so it's going to be a type 8. Okay, but watch this. We're going to say we issued a note $400. So we borrowed $400, paid cash of $200, and issued a note to get the $600 item on the books. So that's a financing type deal. So that's going to be a type 8 as we work number 7. So that's working a little different. The cash we paid was $200, so that's what we want to show on the statement. But we want to show that you bought $600 in long-term assets and you signed a note for $400 that nets you back to that $200. So whenever you're buying a long-term asset, you want to know what the asset costs long-term, just like with that depreciation situation. And you want to know how much you owe. That's helpful information. Okay, paying on accounts payable $700. So this is transaction 8. Paying on accounts payable $700. That's a type 8. Nine, collection of receivables. We said that was type 3. So it's going to be up here. So we collected the $500. 500 of the 800. So we proceed through our statement of cash flow. Then we paid on the long-term note $200. So for the long-term note, it's going to be down here. So we paid $200. Type 8. That was number 8. No, it's 10, excuse me. Okay. So what do we have left? Paid dividends, that's number 11. So I'm going to stick that one in here. And that was $100. And that's a type 10. Finally, we get the one we sold equipment. All we're concerned about is $100. That's a type 6. So we're going to do 14. Going to come in here. Type 6. It's $100. So now what we've done is we spread those transactions types 1 through 6 and 7 through 11, some in operation, some in investments, and some in finances. The information to do that comes and where it says those items should go. Should they be in the source of use in operations, flows and investments, or financing? Now, let's look at what we'll do next. We're going to add up all these items for sources in part 1, and we get what? 1,700. Then we're going to add up the uses, and we get 1,000. So the net change from part 1 is 700. 700,000. We'll just leave it at 700. Then we're going to go to part 2 and do the same thing. We're going to add up the sources. 100. Uses. 600. So we get $500 as a use. And so since it is a use, it goes in parentheses in this last column.
In parentheses, as in like it's negative, right?
Correct.
Got it. Because I only asked because that's how it is in Excel. When you have Excel and you hit accounting, that's what it looked like.
Okay. So cash flow from financing is 600, sources 300, uses. So your change in cash is going to be 700 minus 500 plus 300. So what was our change in cash? Based on this analysis, 700 minus 500 plus 300
500.
gives us a change in cash of 500. And that should be the amount in the cash account. So in that T account for cash, you should have an ending balance of 500. So if you post it, journalize and posted all these transactions, the balance should be $500. So this is our final statement, and the purpose is to tell us that how much we got in operations, and operations needs to be a big plus. If it's not, we got problems. Is cash flow from investments. Investments are a little different. I mean, these are investments that the company is making in long-term assets. So you got current assets, you got long-term assets. So these are the investments in long-term assets. And then financing is where the money comes from. Did you put money in the company? Did you borrow? And of course, the payment for putting money in the company. Okay. Let's see, we have some homework. So we got 4-1, 4-2, 4-3, and 4-4. Then we have 4-5.
Oh, you said homework?
So what?
What did you say? You said homework?
Yeah.
Oh, okay.
So the homework will work this way. Well, do you understand this, you think?
I understand it, but can you like re-go over like how to distinct the ones between from a source and a use, I guess?
Okay, well, very easy. If the journal entry type is 1 through 6, it's a source. If it's 7 through 11, it's a use. So it's already
Okay.
set up. Source
So
type
at this
journal.
point, whenever we're reading the transactions, we're just reading to see if it's 1 through 11 and then go from there off that.
Correct. But 1
Okay.
through 6 is a source. 7 through 11 is a use.
Okay.
And how do you distinguish between investments and cash flows?
Investments are the long-term assets in the company. Okay.
Okay.
Investment in long-term asset. Financing is where it comes from. But where does your financing come from?
You said where it comes from?
Yep. It's
Okay.
from cash contributed, borrowed money, and then you pay some of it back. So these are long-term assets. Okay.
And also, it's in the chart that you showed us at the beginning. It actually tells you which type of entry goes in which where.
Appreciate
Correct.
that, Chess.
Yeah, we
Yeah,
appreciate
I'll just because it
it.
even tells you which
This is,
side it goes on to.
well, we always know 1 through 6 is on the source side. 7 through 11 is on the use side. Okay, so let's look at our homework. C students, y'all got 4 through 4-2. So here are the C students, 4-2.
So you're saying this as in you're not gonna put it in there? Oh wait, are you gonna show us which in the assignments on which one we need to do?
I don't know, depending on how much fussing you're doing today. But you've
Okay.
been today, so
Okay, so
here's C student problem. Here is the B student problem. I'll make sure I put this in.
Just do next class.
Of course. Semester coming to an end. And here's the A student's problem. Okay, so we'll review that, then we move on to a couple other things. This is not that hard. And so by next Thursday, we should be ready for a quiz on this information. Not this Thursday, but next Thursday.
Are you going to post this